I'm at Research Market Insights video for August 17th, 2023. Hey everybody, Willie Dowich here. Glad you have tuned in. Glad you're listening. It's time again for one of our midweek Market Insights updates. It's Thursday. We'd like to call it 3 for Thursday, where we take a closer look at some of the developments this week, some of the things I think should be being paid attention to, some of the things that aren't being paid attention to. I have something this week that is getting some focus that I think is not the right kind of focus. So let's get into it. 3 for Thursday this week. We're going to look at what's happening from a global perspective. Is it just about the dollar? I don't think so. Sector level trends turning over. We've talked about that. Momentum turning lower. Breadth now has followed. Look at that in aggregate and compare, how the market holds up. Will give us a good sense of whether or not we're still in the environment we've seen so far this year, or starting to maybe have more of a repeat of what we saw last year. And then I'll get on a soapbox a little bit and talk about this market timing debate. Saw something last night that I really don't care for. I think it's not untrue, but I think it's irrelevant. We'll talk about that, narratives versus perspectives, when it comes to timing the market at a time when volatility is starting to pick up. So let's get into it. First out of the gate today, this idea of deterioration in global breadth. Is it just about the dollar? So the top here we have the U.S. dollar index. You can, it stopped going down, as started going higher again in the past. That's been something of a headwind for global equities. And you can see as the dollar's gone up, the percentage of global markets above their 50-day averages has turned sharply lower. We're at 90% coming into this month now, depending on whether we look at local currencies or the US dollar-based indexes, where 35% of ACWI markets are above their 50-day averages. The important takeaway here is we were seeing broad strength coming into this month, whether we factor the dollar into it or not. And we've seen deterioration this month. Yes, it's more intense if we look at it on a US dollar basis, but even still, this drop from 91% of markets above their 50-day averages to just 36%, taking out the impact of the dollar. That speaks to some global deterioration that we're going to have to pay attention to as August winds down and we go into the fall months of 2023. From a sector perspective, what are we seeing there? So apologies for kind of overlapping the table and the chart here, but I wanted to be able to get on one slide and to have it large enough that you could see. So upper left-hand corner here are our momentum, price, breadth trends broken out by sector. So if we look across all sectors, momentum trends are deeply negative. Only two areas have anything positive. Price has held up a little bit better. Breadth now is at 0. You add these across at the bottom or add these down through the column, you come up with -12. That -12 is what's reflected in the blue line on the chart over here. The top is the S&P 500. The blue line is this sector trend indicator that is the daily aggregate of all of these various trends. Why are we looking at this? Well, it's dropped below 0 every time we saw that, or the first few times we saw that in 2022. When it dropped below 0, the S&P went on and made lower lows. That changed in October, or in the fourth quarter of last year, and then so far this year. When we've deteriorated, we haven't made lower lows. The test now, well, as we go below 0, is whether or not we undercut that low from earlier this year, or if it's more the pattern that we've seen this year of a little volatility, but then its strength quickly reemerges. So watch what happens now that this trend is being tested. Are we back into the 2022 type environment where deterioration in sector trends means lower lows for the S&P 500? Or are we still in the environment that's kind of been traced out so far this year, where yes, you get a little bit of volatility, sector trends cool off, but then they quickly get back in gear, and at the index level, you continue to make higher lows? Remains to be seen how that resolves itself. Question of market timing and whether it's worth it. So the chart I saw last night was a version of basically these blue boxes here. What happens if you miss 5, 10, 20, 30, 40, how many ever of the best days. And it's factually true that if you start to take out the best days, your aggregate returns are going to go down. It's almost a tautological statement of fact, more than it is some sort of market insight. So I'm not saying that it's not true. I'm saying it's irrelevant. You can make the case, well, market timing is worth it because if you get rid of only the worst days, then your annualized returns, this 1990 through, it says current, it's the middle part of last year. If you miss only the worst days, those annualized returns go through the roof. And so it's cherry picking, I think, to say, well, you'd get rid of the best days and look what happened. That's why it's so expensive to try to time the market. I think that is more of a narrative than it is a useful perspective. Volatility is a tax. That's, I think, what we need to realize. And so as we start to see volatility pick up again and we see weakness beneath the surface, we need to recognize that if we can sidestep both the best days and the worst days, then we end up with better returns and, importantly, less volatility. That's the message of this chart. Fully invested, buy and hold. If that's what you want to do, that's fine. But by trying to be a little bit more adaptive, you can actually reduce volatility, increase returns. So what's the argument for buying and holding? It's not that you come out ahead. It's that you're too lazy or not disciplined enough to focus on some sort of volatility reducing approach. If you focus on reducing the volatility, which means getting rid of the best days and getting rid of the worst days, and incidentally, those tend to happen in clusters. Those tend to happen when market trends are weak, when breadth trends are weak. And so avoiding both of those is not as difficult as it might sound. It's not picking one day here and one day there. It's volatility clusters that we're stepping away from. It's breadth environments that are weak that we're stepping away from. Over time, we come out with reduced volatility from a portfolio perspective and a slight increase in returns as well. So if they tell you, market timing is hard because if you take away the best days, the retort is, well, show me what happens if you also miss the worst days. That's what you end up seeing in a chart like this. So that's the 3 for Thursday. Sorry, it's 4 charts, but I wanted to get the second one on timing in there. But that's our 3 for Thursday message. We're starting to see some volatility. We're starting to see weakness globally. We're seeing weakness at the sector level. We're seeing more new lows and new highs at the issue level on the NYSE plus NASDAQ. That suggests that volatility is returning, that we're not in this period of quiet strength that we were in for the early part of this year. In periods like that, stepping to the side, reducing equity exposure can smooth the path of the portfolio, lead to better nights of sleeping, and we don't need to just buy and hold and hope to hold on as we go forward. So that's the message. That's 3 for Thursday. Thanks for tuning in. Thanks for listening. If you have any questions, reach out. If you don't have questions and just want to reach out and say hi, open to that as well. Have a great week, everyone. I'll talk to you again next week.